Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Russell Rhoads, Head of Research over EQDerivatives, for our review of what's happening with the Nasdaq Volatility Index, or what we call VOLQ. Russell, it's great to see you as always. Welcome back to Trade Talks.
Good to see you. 2 weeks in a row. And
I
we're going to
was
kind
just
of
going to say
stay with the
2
VOLQ
weeks.
theme.
Yes,
Yeah.
2 weeks in a row, despite our Big Ten rivalry going there. But go Rutgers with that awesome win over Michigan this weekend. Anyway, let's talk about VOLQ volumes, what you're seeing with VLQ, because that was kind of a big topic for us last weekend.
Absolutely. Week. And what has happened is the VOLQ contracts have actually been adjusted to have a $100 multiplier instead of a $1,000 multiplier. And we've started to see some decent volumes pick up. In fact, the front month, seen a few contracts trade today. There's well over 100 contracts open interest right now. So if you're thinking about you've got an opinion on VOLQ or Nasdaq-100 volatility, there is an opportunity to have a pure play now.
So what kind of strategy would you use with the volatility trends that you're seeing here?
Well, one of the things, and we talked about this last week, and it's still given us the opportunity, at least at the moment, is that February and March are typically the lowest relative months for VOLQ versus VIX. And just a few minutes ago, I checked VOLQ versus VIX. VOLQ is at a $3.75 premium relative to VIX. VIX is at 23, VOLQ is up at 26.75. But then also the February VOLQ future is at 27.50. So it's at a 75-cent premium relative to the spot index. On the VIX arena, the VIX futures, the February VIX futures are only at 23.35, only a 35-cent premium. So sometimes we'll see divergences between two different volatility indexes that have derivatives available, but the underlying derivatives will not be reflecting the spread. If anything, it's reflecting a wider spread right now. And if you think history is going to hold up and VOLQ will get back in line with VIX, there is a perfect opportunity to sell short February VOLQ future and maybe buy a February VIX future against that position.
And Russell, when you see the divergence between VOLQ and VIX, does it have to do with any reason the way the index is constructed? Because they are two different when it comes to the methodology behind them.
Absolutely. And typically the reason that the spread is wider, at least in January, April, July and October, I'm trying to get my earnings months there, is because there is a reflection through entities doing dispersion trades that pushes NDX implied volatility up. And then the month after we get through the earnings season, we tend to see the two revert back in line with each other. We just haven't seen that quite yet. May have something to do with a lot of outlier moves from the big NASDAQ components. Earnings season this time around, we had 2 or 3 that had really big upside moves and 2 or 3 that we had really big downside moves. The only big one that kind of stayed in line with what we would expect would be Microsoft. So maybe that extra volatility, that extra realized volatility that we got from the big NDX components is holding VOLQ up for the moment. But I do think as memory of that just gets behind us, and you look to February where we don't have a Fed announcement, we don't have any real big announcements that may impact the Nasdaq-100 over the S&P 500, I think there's an opportunity there to play the spread between the two.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.